Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. Oh, I got some exciting stuff to share with you this evening. We're going to talk about the JP Morgan report that they do once a year, always in the first quarter. I haven't seen the one for 2017 yet. Let's see, it's page 13. So this is the one they do Guide to the Markets, and they updated the first quarter at the end of every year, 2000. I don't think the one for 2018 is out yet. I'll have to double check. Probably the most fun. This and Vanguard, the two reports, the most fundamental for me, just for research in terms of what expectations are going forward. Obviously, expectations going forward and actual events on the ground do not. You can't extrapolate the expectations going forward and what's actually going to happen. That'd be silly to do, but it does give you a background to think for the long term trend line, linear projections, and ideas of what you can use in your own investing and in financial planning. Anyway, so I want to start. I'll go over a lot. They got, I don't even know how many pages they have on this thing. It's just fun. It's just fantastic. So I'll go over a couple of pages, in the future. I want to show you the one that I like, one of my favorite ones actually today, right here. It's called Annual Returns and Intra-Year Declines. And every year they do this. In fact, I don't know where my chart is. I have a chart down here someplace that goes back to, I guess this one does go back to 1980. So they've added a year. So mine was 1982. Okay, so they start with a framework in 1980. And every year I've up to 2011, 12, 13. This one's the 2016. And what this says is S&P intra-year declines versus calendar year returns. And I want to show what this means to you. Despite average intra-year drops of 14.2%, annual returns are positive in 28 of the last 37 years. So intra-year drops average of 14.2%. And what that says is from top to bottom, every year the market has a decline of about 14% or so. So here's 2016. The market was up 10, but it had what's that, top to bottom, I don't know what they call it, but top to bottom, it fell from whatever its high was, 11% off its high. And it still was average 10% for the year. Look at this. Here's 2015. The market was down 1, and yet it had a top to bottom decline of 12%, even though the year was only down 1. Here's a year is up 30%, and even that had a top to bottom of negative 6, even though the market was up 30%. This is 2011. This is 8, 9, 10. Yeah, this is 2011 right here. Yeah, it's definitely 2011. I remember that. It was in August, July, halfway through July to end of August, down about 19%. And yet the market had a 0 and didn't make any money. But still, how easily you can forget that the market was down that substantially in that year. It's amazing when you think about it. Even this year right here, this is 2009. The market had a top to bottom, and not just from the top. It's just from the volatility. At some point in the year, the market was down 28% from what it was at one point. And that was from January to 2009, because March 9th of 2009 was it. It was that the lowest it's ever been for years and years and years. The following, even though it finished the year up 23%, the following year, it finished the year up 13%, but even during that time, it was down 16% at one point. 2011, like I said, it was down 19% at one point, even though it finished the year broke even. 2012 was down 10% at one point, even though it finished the year up 13. The point about this is this is what I was kind of talking about Dave Ramsey's thing the other day. He says the market averages X, and you can then take X minus a certain percentage off a year, and you'll be fine. But it's just you can't. Yeah, look at this. So here's the market up 28 of 37 calendar years, but here's what people actually went through. Negative 17, negative 18, negative 17, negative 13, negative 34, even though the market was up 2% for the year. What was that? Probably 87 right there. Negative 20. You can just see it. Even in up years, the market was down 19, 12, 11. So the point is, you can never rest. You can't just rest on the averages, because you're going to go through this on a regular every year, the down market. You have no clue what's going on for the end of the year. So when we're sitting, I'll never forget, 2011, we're sitting there, and I was doing a seminar up in West Point, Highland Falls, New York, and I had a call from a frantic client. get me out, get me out. I said, I'm driving, I can't. You got to call in the office and they'll do it for you. But I said, I don't think you should. We've already been through some pretty significant declines. I'm not saying the market's not going to drop, but we don't know. And his whole thing was, I can't remember what the issue of the time was at that point. It wasn't just him, but I just remember like it was yesterday. And he said, I can't stomach this happening again. And how easy we forget, don't forget October 2007 to March of 2009 was really down here. He said, I just can't handle that. And so he got out. And I mean, again, that's his money, do whatever he wants. But, look what he missed. He missed a 13% up, a 30% up, 11% up, a -1, 10% up. And last year's up, but 30% again. Just because this one thing knocked him out. He couldn't take it anymore. It's too bad because he missed out a lot of growth that he could have got if he just would have stayed in there. Now, hindsight, you don't ever see these red marks. You only see, this is what the market did. And you say, okay, so, we've had, like I said, every, 4 out of 5 years. Is that what it is? Yeah, 4 out of 5 years. If we have 5 consecutive years, 80% of the time they'll be positive. Every year, every third year, the market's negative or something. I can't remember off the top of my head, but something like that. So every 3 years, the market has one negative year or something like that. But if you just look on the average and first of all, you just look at the average, you're going to assume you're getting 10% a year or 10.5% or whatever it is. That's just because the average. It doesn't show any negatives. It doesn't show this right here. It just says we started here and then we ended. We started down here. Where did I go? Well, I got to go way up. Oh, man, it really took me down. So we started, bear with me just a second, my friends. We started with an S&P 500 of 80. Now we're up to an S&P 500 of 20, 200, whatever it is today. And so they say, here's where we started. Here's where we are. And it just goes whoops, up to the northeast. That's what the average return will show, a linear. But then if you go a little bit more, it's like a fractal in mathematics. You go a little bit deeper, you'll say, well, the average did start here and did go up there, and that is the average, but the average contains up, down, up, down, up, down, up, down a little bit, up, down, down, up, down, up, down, up. So you see a whole lot more ups than downs. So if you see a linear, you're going, whoops. If you see a more like going a little bit deeper, year by year, you're seeing like that, a little bit more choppy. But then if you see intra-years, it goes shoop, 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 and it's still going up. But that's that's fractals right there. Again, fractals diving deeper than from the bird's eye view, a little bit deeper and then a little bit deeper though. So bird's eye view, Google Maps, and then on the ground, boots on the ground. And so that's what I just want to share with you today, because I think this gets overlooked a lot, the volatility of the markets. And again, this is just the S&P 500. If you take in the Russell 2000 or the total stock market index or the emerging markets, or if you take in international or gold or real estate, it doesn't matter. They're all going to have the same kind of concept here as this right here. So keep that in mind as you're investing. If you're in the stock market is the S&P 500 is the proxy, you're going to get any single year a down climb. A down market. There's nothing you can do about it. Just remember that. You're going to get any single year the market's going to fall, and fall big, fall painful, violently, and quickly. And you'll be taken off guard. No one predicts any of this stuff, by the way. All these active managers, oh, no, they don't predict anything. I just ask them, what did you predict here? Market's up 27% for the whole year, and at one point it's down 19. What was your prediction? No one's going to say that they predicted that. It just doesn't happen. So remember, as you're investing, if you're going to invest for growth, i.e. in the equity market, the stock market, you've got to be content on the downs on each year. If you can't be content on it, you shouldn't be in there, frankly, because what's going to happen is you're going to sell. When it's down 19%, you just lost a fifth of your total capital. And if you just would have hung on there, you would have been up, big time. You would have missed probably not maybe a doubling of your money over 5 years. I don't know, but it would have been pretty doggone close. So don't do that. Hope this helps you. Again, don't forget to thumbs up. Don't forget to subscribe down there. Comments are always welcome for sure. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.